Hello and welcome to Business Today. I'm Siddharth Zarabi and you're watching Economics. We are counting down to the release of the first advance estimate of GDP growth for FY25 in just a few minutes from now, and by all reckoning, the GDP growth rate is seen by a majority of economists that we have polled to slow down to perhaps a 4-year low on account of a decline in growth in the second half of the year. And joining me now to discuss and decode the numbers as they come in, Indranil Pan, Chief Economist at Yes Bank, and also with us Sunil, Sinha, one of the senior most economists in India who tracks these numbers very, very closely. Indranil, coming to you, what are your expectations as far as this set of numbers that is about to be released in a few minutes is concerned?
After the 5.4 surprise in the Q2, we actually have revised our estimates down to about 6.2%. And it is lower definitely than what the RBI and the government's estimates are.
Okay. Sunil, what are your estimates?
Well, as Indranil said, I mean, after the second quarter numbers, I have also revised my estimate for the 24-25 to 6.4%.
Okay, let's try and bring up those numbers that we have, because we have heard both of our economists on the show talk about their numbers. Indranil, what is the reason that is led to this likely decline?
Well, I think number one, obviously, is that the government has not been spending adequately on the infrastructure plans that they had set out for the year. That is mostly because of the elections during this year. They have tried to sort of start pushing capital expenditures, but ultimately, I don't think time is adequate enough for the remaining 3 months of the financial year to find adequate projects through which they can actually make up for the slack that we had seen in the first quarter in terms of the expenditures. The second thing, obviously, is that we are still not confident about the domestic consumption. We continue to hear that the rural sector is ready to sort of pick up while urban sector is actually slowing down. But I still have my doubts a little bit on the rural sector because wage growth, or the real wage growth in the rural sectors, are also quite low. And that, in my opinion, is more of a challenge than the positivities that came out for this year in terms of the agricultural growth. And external growth is also likely to be on a slower track, which necessarily means that we don't see any clear indication from the private sector to actually crowd in the public investments that have been happening over the last few years. So I think these are the critical elements that we look at when we talk about a slowdown in the economy.
Okay, the slowdown in the economy, and on the screen for you viewers were the numbers, and we'll try and bring them back up of the poll that we have to show you about the growth forecast. Nomura at 6%, you see a bunch of other estimates at 6.3%, one going up to 6.4%, and in fact then we have 3 estimates including Bank of America Securities, ICICI ICRA at 6.5 and Bank of Baroda at 6.6 to 6.8, and the 2 guests on the show have also given us their own estimate. Sunil, the inability of the government spendings, particularly on capex, that got impacted due to a variety of factors, do you think it's a factor that continues to linger, or has that been addressed?
Well, to a large extent, it is unlikely that government will be able to spend as much as they had budgeted for this fiscal. Not because, the elections somewhat slowed down the overall capital expenditure, but I guess there are other reasons also which is likely to have an impact on the overall capital expenditure this year. I mean, last year also we saw that the overall budgeted number was slightly lower, when the actual estimates came. This year, my hunch is that the slowdown and, backloading the entire capex in third and fourth quarter probably is not possible because infrastructure spending and infrastructure projects take their own time. So if you have missed 1 quarter of spending, then it is very difficult for you to catch up in the next 2 quarters to cover up for the loss. So the likelihood is that you will see lower capital expenditure as compared to the budgeted this year. I mean, this is not to say that government will have any budgetary constraint. I mean, the revenues have been buoyant, so that will not be a constraint, but certainly spending will be a major issue.
One of the reasons, viewers, that this number is important to track and literally just seconds away from the number to be released is that these estimates, the first advance estimate goes into the budget numbers. Remember that we are just about 3 weeks away from the union budget, and the nominal GDP growth number, which is very crucial to the budgetary numbers, is based on this, and that also we know that takes into account certain projections for revenues, for expenditure, and the fiscal deficit as well. And the budget, as always, on the 1st of February, this time it's Saturday. Now the key question is that if the number is 6.4%, it would be lower than the projections that we had from the RBI as well as the finance ministry. And that, by the way, viewers, we have hit the clock on 6.4% is the number. The FY25 GDP growth number is seen at 6.4% as per the first advance estimate. Breaking news here. GDP for FY25 growth is estimated at 6.4%, and this is versus 8.2% in the previous financial year, FY24. And therefore, this kind of raises a big question on some of the forecasts that we have had. The GVA growth for FY25, and I am now getting all the numbers. FY25 GVA growth is seen at 6.4% versus 7.2% for the previous year. FY25 nominal GDP growth seen at 9.7% versus 9.6% in FY24. The three sets of numbers that we have had. Agriculture sector growth seen at 3.8% versus 1.4%. So a significant uptick in agriculture. This is the number. Mining sector growth seen at 2.9% versus 7.1%. I repeat that. Mining projected to grow at a much lower rate at 2.9% versus 7.1%. Manufacturing at 5.3% versus 9.9%. So agriculture is projected to be well above the previous year, but mining, manufacturing down. Construction number that we have now again down at 8.6% versus 9.9% in the previous financial year. So construction, manufacturing, mining all projected down. Agriculture seen at 3.8% versus 1.4%. The overall GDP number at 6.4% versus 8.2%. GVA number at 6.4% versus 7.2%. Services sector growth, now we have that number as well, 7.2% versus 7.6% in FY24. So four of the important components that we have data for so far: mining, manufacturing, construction, services, all down. Agriculture, the fifth one, seen doing much better than it did in the previous financial year. And now it's confirmation, viewers. The GDP growth estimate of 6.4% for FY25 is the lowest in 4 years. India GDP growth is now projected to be at the lowest level in the past 48 months. That's the big headline at this stage, and I want to go to both my guests for their initial reactions on the numbers as well as the sectoral data that we have so far. Indranil, to you first.
Well, nothing much to comment on the numbers per se. Mine was 6.2. A lot of other people that you sort of polled were at 6.3 and 6.4. But I think the very critical concern for me is the manufacturing sector. And this manufacturing sector was one which was holding up the growth on the GVA side. And given the fact that we have now a very changed global atmosphere because of Trump coming in and tariffs being raised, fragmentation becoming the rule of the game to a certain extent, and with expected stimulus coming from China, I think the input costs also, along with the depreciation of the rupee, is likely to be on the higher side. Now, if on the other side, my sort of disposable income, so to say, does not increase, that really creates a pressure on the profit margins of the manufacturing sector. And therefore, manufacturing sector could continue to remain, in terms of its performance, relatively muted in terms of the profit numbers in the coming financial year also. And I think this is the most important takeaway that I would have, which also has therefore its implication in terms of the taxation side. So, for example, the corporate taxes in the current financial year has been a lot weaker than the budget. Income tax has been holding up. So that is a challenge that the possibly the next budget will also have to sort of look into, including also the GST numbers.
Okay. We have some more data before I go to Sunil. Industry growth seen at 6.2% versus 9.5%. That's the industry growth. Private consumption growth at 7.3% versus 4% in the previous financial year, which is FY24. Gross fixed capital formation growth at 6.4 versus 9% in the previous financial year. Government consumption expenditure growth at 4.1% versus 2.5%. So government consumption expenditure growth is being seen as higher. So a bit more color to those numbers that we got. Sunil, your thoughts on what we have been hearing?
Siddharth, I mean, by and large, the numbers are on the expected lines. I mean, as I said, my estimate was 6.4%, and the provisional numbers put it at 6.4%. But yes, the breakup, both from the demand and supply side, certainly raises many concerns. And as Indranil has highlighted, I mean, manufacturing, which has been holding up till last year, has suddenly gone down. And impact of that will also be seen in the overall corporate tax collection. If you really look at the GVA, GDP, both of them are at 6.4%. And you would recall that last year, the GDP was way higher than GVA. I mean, in fact, abnormally higher. And a large part of that was due to much higher tax collection than anticipated, which appears to have flattened. And to a large extent, that has started becoming visible in the, the sales projection or sales estimate, which a lot of, corporate sector has been putting out, particularly the FMCG companies. So clearly, I mean, the issue is both, related to the investment as well as consumption, because these are the two major drivers of growth from the demand side. Exports, as we all know, I mean, merchandise exports are not doing so well, whereas services exports are. But if we just set that aside and simply look at the, other two demand drivers, then concerns are that both investment demand will be, I mean, has been impacted as compared to last year, and so will be the consumption demand. And let's not forget that the 7+%, private final consumption expenditure growth that we are seeing this year is mainly because of a very low base, which was 4% growth last year. So clearly, I think, the forthcoming budget will have to look at these issues very closely and has to do some kind of a fine balancing where government capex will have to do the weightlifting or heavy lifting, as it has been doing in the earlier years, and hoping that the private capex will, catch up. But given the demand condition, particularly the private final consumption demand, it's unlikely to really go anywhere higher than where it is now.
Indranil, what does this growth number really imply for central finances? Now, you've alluded to that, but what kind of note are budget makers likely to take of these numbers, and will it influence some of the policy choices that are made in the forthcoming budget?
Uh, well, I think there are two ways of looking at it. One is whether you want to solve this slowdown through the fiscal policy or whether you want to solve the slowdown through the monetary policy. Now, my own sense is that even if I get a 50, 75 basis points cut, uh, uh, and with the sort of consumption atmosphere remaining weak, I'm not sure whether that will pretty much help in terms of pushing growth on the overall perspective, including the private capex that we are looking at. So my perspective, therefore, is that this is still a case and a situation where the supply side needs to be pushed, not only for reviving the current growth, but also clearly establishing the platform in terms of the future growth. So a certain few things that I can talk about is very rightly so, the government in the last policy had come out with its employment scheme and the skilling schemes. This year, we didn't have much time, and therefore, what we read is that a certain portion of the funds that were allocated to these schemes are not being used. So there, in my opinion, after experience of about 7 to 8 months, the government should be able to fine tune these schemes in terms of the employment generation structure and the skilling structure, so that we actually sort of are able to increase our employment. Uh, and that's the only way we can talk about percolation of national income across various categories of the population, and then therefore build up the structure for domestic private consumption. So that's one part of the story. The second, of course, is that the agriculture sector needs to be looked at in a very significant way. And the reason I say so is that we are undergoing significant amount of climate changes, and global food prices are something that continues to worry me. And minor sort of shocks in terms of climate changes can actually affect global food prices in a significant way, because the carrying stock of global food is not very significant, as we have seen certain climate disturbances over the last 2 years. So productivity in the agricultural sector needs to be pushed strongly. And I think the amount of funding that the government had put out of the budget, from the budget in the last year, if I'm not mistaken, only about 100 crores for agriculture and R&D. That has got to see a significant amount of increase. The other thing that we need to sort of on a very war footing need to sort of solve, and this is, in my opinion, one of the biggest impediments why the China plus one strategy has not been very successful, even though our corporate tax rates have been brought down to ASEAN levels, is the cost of electricity and the logistics cost. The logistics policy of the government is there, and I think these are some of the issues that the government needs to take into cognizance very significantly if they have to push the manufacturing sector, which still, in terms of the share of GDP, remains at almost the same level as the last 5 years.
Sunil, Indranil alluded to this earlier during our conversation, and I want to pick that point up. Given the likely impact on government tax revenue, you already have corporate tax rates lower, plus if manufacturing were to go down, will the government and budget makers be hard pressed to respond to some of the more popular demands that have been of somehow lessening the pressure on the middle class, on the consuming class when it comes to income taxes? Does this kind of signal the fact that not much can be expected on that front in the budget?
Well, I mean, we have been listening to these kind of demands now for number of years. That if we really want to address the consumption demand, which has been a challenge for the economy for last several years, then certainly something needs to be done. and more money should be put in the hands of the middle class. And that can probably happen in two ways. One is that the overall inflation adjusted income goes up significantly, not only for the middle class, but across the board, particularly the people who are at the bottom 50% of the pyramid. And the second is that if that cannot be done easily, then certainly one way forward is to reduce the income tax, so that the households can have a higher disposable income, which they can use for higher consumption. But it is easier said than done, because as we all know that government has been focusing a lot on the investment, particularly the government capex. The revenue generation is as important as increasing the real income of the people by reducing the income tax and other taxes and so on and so forth. So it will not be very easy. So my own hunch is that like last year, I don't expect anything much happening so far as income tax is concerned. But certainly, addressing the issue of inflation and somewhere, containing that in the targeted territory of 4% can certainly be a positive, not only for the overall economy, but for consumption demand as well. But one has to really see that what measures a government can really take. I mean, it has to be a combination of multiple things, right from the addressing the agricultural issues, because we all know that the key driver of consumer inflation right now is the food inflation. But at the same time, let's not forget that the geopolitical situation is not very favorable at this point of time. As a result of that, there has been a pressure on rupee. Rupee has been depreciating. So importing oil will certainly be an issue and will have implication for overall inflation and inflationary expectation in the economy.
Absolutely. And viewers, even as we were talking about budget prospects, just a bit of trivia: the Election Commission, which has announced the dates for elections to the Delhi Assembly, has also told the government that there can't be any Delhi-specific schemes in the union budget. Not that much was being expected, but just to tell you about how politics and policy making sometimes comes together. But the big headline for this number: India GDP growth at a 4-year low. As the experts on our show just now were telling you, much of it was expected, factored in, but it clearly has implications for both policy choices on the fiscal side as well as ultimately on the monetary side, and some of those constraints quite difficult for the government to address at this stage. But we'll have to wait for how the government reacts to this number and how it responds in the budget, and we'll come back with more details with more expert views. For now, thank you very much, Indranil and Sunil, and you the viewer. We'll be back with more. Until then, goodbye.
The biggest flashpoint in Delhi Dangal. The luxurious bungalow of Delhi Chief Minister and the alleged mega splurge. Dubbed Kejriwal's Sheesh Mahal by the BJP, the bungalow became a focal point of Prime Minister